Good afternoon, fellow investors, and welcome back to InvestTalk. My name is Lou Guerrero, and I will be your host over this next hour. And today, we are more than halfway through April. It is Tuesday, April 16th, 2024. And what an exciting, or at least interesting, month it has been so far. Now, before we move forward, I want to give you a brief update on the InvestTalk Market Madness, and that is to say that per the rules of our game, we gave the first place winner 1 week to respond to our email, and as they have not, we have now reached out to the person that finished in second. So make sure to check your email if you were a participant in our InvestTalk Market Madness, because there could be a little surprise for you, and we look forward to hearing from you. Now, as always, our goal here is our goal every other day, and that is to have you leave a better investor than you came. Now, in order to accomplish that, I need to hear from you to hear about your investment and finance questions. So we go through some questions that have been left for us on iTunes and on YouTube, but more than anything, we love to hear from you live. So feel free to call over this next hour. Our phone lines are open at 888-99-CHART. That being said, we'll talk a little bit about market performance and run down the show topics, but not before we answer our first caller question now.
Hello, Stephen, Justin. This is Jim in Miami. Just want to thank you guys very much for all the insight you provide on this show. It's really helpful. I have a question today about Equinor, EQNR, trying to get into the energy market. You guys are really good at finding the turd in the punch bowl. So if you could please tell me what I'm missing here in this stock, I'll listen on the show. Thank you so much for your help. Bye-bye.
Well, the question was about EQNR, which is Equinor. And Equinor is a Norwegian oil, gas, petroleum exploration and transportation company. And so taking a look at their revenue, it looks like over the past 5 years, they've had 6.3% year over year annualized revenue growth, which is pretty solid. Their profitability looks decent. It took a dip, as did profitability for a lot of energy companies in 2023. And so in 2024, it's projected to take another dip as well. So taking a look at their cash flows have fallen, as has their profitability, as I previously mentioned, and their relative strength is kind of lower than you would expect, given that it's within the energy space, and energy specifically within the U.S. has had a significant run-up year to date, whereas Equinor is down about 12.23%. So why is that? Even though this company's relative price seems pretty reasonable, and if you were to find a company within the U.S., within the U.S. energy sector who maybe had slightly better fundamentals and better momentum, I would say this is a great price to buy it at. But if you look at its revenue breakdown, 99% of its revenue comes from Norway. And we'll talk a little bit later in the show about how Europe's growth is supposed to look this year, how it's projected to look relative to US growth. So just given its concentration of where these revenues are coming from and what demand is supposed to look like coming out of the US versus coming out of Europe, I would have to pass on Equinor. I would probably focus on either one type of company that's more geographically diverse in its revenue, or somewhere that it's at least going to focus in a place where demand is expected to grow outsized relative to the global market. Thanks for the call. Now, we got a lot of ground to cover over the next 40 minutes, and here's some of what we have planned for you, all time permitting. Our main focus point concerns this question: why is inflation so sticky? We'll talk about rising housing costs. We'll talk about gas prices. We'll talk about oil prices, and we'll talk about how that impacts inflation overall. Also, I want to discuss U.S. growth and how it's supposed to double the rate of any other G7 country. So what's growth going to look like in the U.S.? What's it going to look like elsewhere? And what does that mean for inflation going forward? We're also going to talk about U.S. home building. As some of you may know, housing starts numbers were released today, and it told us a lot about residential housing and what we can expect going forward. Also, should we have time at the end of the show, we'll talk about the market's reaction to the tension in the Middle East and what that says about whether or not valuations are running away, and if we are in, as some people have thought for some time, a bubble. We also have a lot of voice bank questions to get to. One about banks' resources and another on VTI, the Vanguard Total Stock Market ETF. We also have some questions that are coming from our YouTube channel. If you haven't checked that out yet, please head over to YouTube. We put all of our shows on our InvestTalk YouTube channel where you can look at the charts and data that Justin and I look at every day when we answer your questions. And of course, we hope to hear from you live at 888-99-CHART. Let's talk a little bit about the market. U.S. equities finished mostly lower in a pretty up and down Tuesday trading session. The S&P 500 ended down for the third straight session. The equal weight underperformed the capped weighted index, interestingly enough. And that's because a lot of rate sensitive names have been selling off today, including some REITs, utilities, and small caps, as well as some home builders. Outperformance today came from a pretty narrow swath of the market. AI did well. Managed care, healthcare, semis, large cap software, restaurants, apparel, grocery stores did pretty well as well. The 10-year yield was also near its highest levels since early November, and the 2-year is once again nearing 5%. Gold finished up about 1%, and overall, I would just say the market continued to lean risk off. And so a lot of this was a tone that was primarily continued by the driving of a hawkish repricing of Fed pivot expectations after last week's data and some more data as well. Market now actually pricing in fewer than 2 rate cuts. Last month, it was pricing in about 3. Last week, even, it was pricing in 2. Now it's pricing in fewer than 2 rate cuts going into the end of 2024. The S&P now down nearly 3.5% from its peak and below the 50-day moving average for the first time since last November. And a lot of that is not just about the Fed, it's about geopolitical uncertainty, another big overhang with the Israeli response to Saturday's Iranian attack still unclear. Another thing to note from my perspective is the volatility spike. The VIX is up 50% plus in just 3 weeks. And like I mentioned, March housing starts came in at a 1.321 million versus the consensus of 1.483 million, but we'll talk a little bit more about that later. Looking forward to the rest of the week, we'll see some initial claims in existing home sales on Thursday. Now we're going into a short break, and on the other side, we will tackle your finance and investment questions. Please remember, you can call anytime. Our voice line is open at 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
Hi, Duncan from New York. Thank you for all that you do. Quick question on a very risky play. Not sure if it's like really out of the ordinary, but I want to look at stock ticker SURG, SURG. It is a company that caught my attention because the ROE is like close to 100% and the ROI is close to 50%. I want you to just take a look at that from me. It was also suggested by another web service as well too for stock picking. I know this is a risky play, but I just want you to do a little bit more of a analysis. Appreciate it. SURG stock ticker. Have a good day. Bye.
So stock ticker SURG is SurgePay. And SurgePay is a technology company that aims to build supply chain software platforms. And they had some good news last year, which is they were profitable for the first time. Their earnings per share was $1.38, which is supposed to dip to 85 cents this year, and then it's projected to go further down to 80 cents the year after that. It's a very, very small microcap company, 72.15 million if you want to be specific, and its debt levels are pretty much none, about $5 million in debt. So the question becomes, if this company, who would look like to be at a pretty reasonable valuation given where it's been over the past 5 years. It's at a 1.9 price to book relative to 28 pretty recently. And so the question becomes, why, if this company is finally making money, did its price go down? Well, it looks to me like the reason is because cash flow didn't improve like profitability did. So what does that tell us? That tells us that the company's earnings probably aren't sustainable earnings. They're not what we call quality earnings. So even though this company started to make money for the first time, you can see the earnings aren't quality based upon the projections of what's supposed to happen next year. So I'm looking at it, the market doesn't think it's even as low as it should be. The short interest is still hovering at about 8%. So I would have to pass on SURG. It looks to me to be even more risky than you might even realize, and probably is going to continue to head downward below where it's at right now, which is $3.66. Thanks for the call. Now, from time to time, we also receive questions from the comment section of our InvestTalk YouTube channel. And here is a question that came in from one of our viewers. And it says, sorry, my call quality wasn't the best. It was actually REPX I was calling about, not RPTX. I remember this call. Looks to have a high insider ownership, high profit margins, and does have a high dividend. So Riley Exploration Permian Inc., REPX, is a oil and gas exploration company. And taking a look at its revenue growth over the past 5 years, pretty significant. It looks like they were doing minimal sales up until 2021 when it exploded. And because of that, their 5-year average growth has been 129.7%, certainly something that is not sustainable long term. Now, what's that done for its profitability? Well, its profitability has kind of tapered off. You see that they didn't make any money at all in 2019, 2020, and 2021. Then in 2022, they were profitable. Their net profit margin was 36.7. It's dipped down to 29.8, and now next year it's projected to be 35.1. And so even though over the past year rather, energy has generally been flat, though slightly up. If you look at the median name within the energy space, this name's actually down 38% in the past year. It's up 5% year to date. And so its relative strength dipped down to well below 80, and now it's back up to about 90, which is good. Taking a look at their debt levels, it's got a lot of debt. $357 million on a $613 million market cap name. So, looking at this, I don't think the insider ownership is the biggest cause for concern here for me. What the biggest cause for concern is the variability in cash flow and profitability. So it has had outsized revenue growth. That's not going to be sustainable. It has a debt load that for a small cap company seems to me to be too large in this rising rate environment. I would look for other names within the energy space, but I do like where your head is now. Thanks for watching. Let's go ahead and answer another YouTube question that came in on PRFT. The question is, what do you think of PRFT stock for a long-term hold? Now, PRFT is Perficient Inc. And while this pulls up, Perficient Inc. is a digital consultancy services company. I think I actually looked at this stock the other day. So PRFT saw some outsized growth within the pandemic, which, given its operating space, explains why its relative strength improved really in mid-2020 and then in 2022 as well. That's where its outperformance relative to the S&P 500 really started to take off. And so how's it performed over the past year? Well, it's down 34%. And why is that? A lot of that is due to forward-looking guidance. So there were some forward-looking guidance from PRFT that suggested some of their costs would be increasing, and so their margins would be hit as well because of that. So it looks like over the past 5 years, the revenue growth has been pretty consistent, actually. It's tapered off a little bit, actually, from 2022 to 2023, but the 3 years before that, it was pretty significant. But given that its revenue growth over the past 2 years has kind of tapered off, even though its annualized growth is 13%, it just doesn't seem to me like a pretty sustainable name in terms of its growth, and the market has believed that as well over the past 3 months. It's really fallen off a cliff, and it looks like it's lost its support. It's going to continue to head downward. So given its momentum and a lot of the forward-looking guidance from this company, I would have to pass on it. But thanks for watching those videos. Now we're moving into a quick break, but our phone lines are open. So feel free to call anytime. 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success.
My main focus point today concerns this question. Why is inflation still so sticky? And in order to understand inflation, especially now, you need to understand housing prices, you need to talk about oil, and you need to talk about gas. Because in March, inflation surged unexpectedly. And most of that was due to a persistent increase in shelter costs and escalating gas prices. Now, as a whole, CPI rose by about 40 basis points in March, which was 3.5% from the same time a year ago, slightly above the anticipated 3.4%. And core CPI, which excludes volatile and energy prices, also saw a 3.8% increase from the previous year, which did a lot to reinforce the trend of persistent inflation. So the months before, prices were increasing as well, but a lot of that, some experts attributed to seasonal factors. So what the March report really did is it cut some holes in the disinflation narrative. And so you've seen hawkish repricing because of that. And all of this is more evidence that housing costs, which have remained stubbornly high, defied those anticipated moderation in rents and homeowner expenses. So this anticipated, or rather unanticipated, continuance of inflation that, like I said, has led to a reduction in expectations for not just immediate cuts, but the time in which we'd start cutting. Originally, at the beginning of the year, some thought that would be March. Then even by last week, it moved into maybe June. Now some people think it's not going to happen until the fourth quarter. And so that's had an effect on stocks and even bond yields. And so despite the real-time data, which has been somewhat normalizing in market rents, CPI measurements continue to reflect these higher housing costs, which suggest kind of a delayed manifestation of these trends in the official data. And that's not the only thing we really learned from this report. There's been an impact on car insurance and maintenance costs as well. Notably, these increases in these areas in March were linked to these previous hikes in car prices that were due to the pandemic. Now, it's not all bad news. Luckily, these specific increases are not really expected to be long-term drivers of inflation because vehicle prices tend to stabilize over time. And another silver lining is that core goods prices, particularly outside the used car market, actually moderated in March. And so this trend kind of aligns with the idea that some of these pre-pandemic price levels could be tapering off in the long run. So what really then are the broader implications to economic policy? Well, the Fed doesn't look at CPI as much as the news media does, right? The Fed's preferred metric is personal consumption, the PCE index. And with what came out with PPI last week, the Fed actually kind of had a moderated adjustment, and some observers as well had a moderated adjustment to PCE. So really, most people are going to be looking towards PCE at the end of the month to tell us what potentially the trajectory of rate cuts may be this year. Now, overall, while inflation remains a significant concern, particularly with housing and energy costs, the broader economic impact and policy responses might be more tempered than immediate market reactions indicate. Now, we have a live call. Will in San Diego has a question about NLY. Do you own it or are you looking to buy it?
Oh, good afternoon, Luke. I don't own it, but I heard on the internet that it's paying a nice dividend. So I'm wondering if this is a trap or something I should seriously consider.
Well, it is certainly paying a large dividend. It's paying a 14.7% dividend right now. And that's because it has been pretty weak relative to the overall market since 2020. And so this seems to me like an example of a dividend that may not be sustainable. And that's because the cash flow of this company and the profitability of this company are falling as well. Now, people think about dividends as income for them, but it's more important the company that you're exposed to while you're seeking to gain that dividend. Because when a dividend is issued, the stock price falls, right? Because the company is paying in cash and the cash is leaving the company's balance sheet, which means the value of what the company is less. So if you invest in a company that's price isn't performing as well as the market over long periods of time because it's fundamentally not sound, then you're actually worse off, even with that dividend. So this seems to me like an example of a company that fundamentally is not that strong. They have a lot of debt loaded on them. I mean, a lot of debt. And their cash flow is fledgling as well. So I would pass on this. There are some better, more moderated dividend providers that are actually going to be good long-term hold investments as well. Thanks for the call.
Oh, okay. Thank you.
Now, the next InvestTalk, we'll look into this topic, 15 stocks that have destroyed the most wealth over the past decade. As a group, these stocks wiped out an estimated $281 billion in shareholder wealth over the past 10 years. That's tomorrow, but for now, I'm Lou Guerrero, and I'm ready to take your calls at 888-99-CHART.
Hey InvestTalk community, Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast.
Coast in California and Santa Cruz. Thomas, your question is about FLIN. Do you own it or are you looking to buy it?
I may be looking to buy it. It's something that I've been just doing some research on, just basically exposure to India. I mean, I remember being in high school and my economics teacher just talking about basically just the birth rate in China versus the birth rate in India. And it's something that's kind of always been in the back of my mind about just like the long-term kind of change over to manufacturing in India. And I mean, it'd be something that theoretically would be a very long-term hold. And this was a fund that I found that was the lowest expense ratio that I could find off just basically quickly looking into it. So mostly I'm asking about that thought process. Would it be better to be looking for individual names? I mean, obviously I'm not going to be able to find tons of information about specific companies in India super easily. But just kind of like more about that thought process and kind of, I mean, it kind of has been just going up and up and up, and I've been following it, and it's just been like, oh my gosh, I wish I bought it then. But since the creation of the fund, it's kind of gone down and back up, and I'm kind of viewing this as Chinese stocks go down, this goes up potentially. I was just wondering what you think about this.
Yeah, well, I like your thought process. And it's actually an interesting segue into my next talking point, which is talking about the divergence in growth globally, right? And one of the areas that within the emerging markets that is projected to do very well this year is India. And so taking a look at this fund, it is primarily a large and mid-cap Indian equity fund. And you are right, its expense ratio is very low, especially for an emerging market country. It's only 19 basis points annually. And it's also important to note that given some compliance around investment funds within the US, they're going to have to cap some of the names within this. So you're not really going to get a true market cap weighted exposure of the large and mid cap space. And that's because there's probably some diversity requirements. And so given the Indian market is probably a little more top heavy than other markets, they're going to have to cap those names. So that's also important to note. But no, I do like your thinking. I do like this fund. I think it's cheap. I think looking for well-diversified funds, especially within these emerging markets, is a better route to go than trying to invest in individual equities. Because I remember from my days at DFA that the Indian market specifically has a lot of compliance issues around owning individual stocks. So it's more difficult for foreign investors within India or to invest within India for individual stocks. So I think your head is in the right place. I think you're looking for the right things when you're looking for a fund to invest in. And I think this is not a bad one to invest in if you're looking to get some Indian exposure. Thanks for the call. Now, like I said, it's a great segue to my next talking point, which is about a new report released by the IMF. And it predicts that the US economy will grow at a rate that doubles that of any other G7 nation this year. And so according to the latest World Economic Outlook by the IMF, the US is expected to see a growth rate of 2.7% in 2024, which is an increase from the 2.5% that was estimated for 2023, and really a significant adjustment from earlier forecasts. So why is this happening? Well, a lot of that is because of robust household spending and investment. And the US's closest competitor in economic growth in the G7, which is Canada, is projected to only grow at 1.2%. Germany, which is the weakest of the G7, is projected to grow at 0.2%. And this matters globally because the repricing of Fed rate cut expectations, which we've talked a lot about due to this growth trajectory, has affected global stocks and currencies, particularly in Asia. Now, we talked about the repricing of cuts in terms of the degree to which we're going to cut, right? Starting at, some people thought it was 7 at the beginning of the year, moved to 3. Now it's actually less than 2 after being 2 last week. But the timeline is also important as well. I mentioned earlier that maybe it's going to shift into the fourth quarter at the earliest, if not even into 2025. And so there's going to be a global economic impact because of this. The robust US growth is seen as kind of a buffer against a global economic downturn. Although you've seen some demand-driven inflation becoming less of an issue in Europe and the UK, because the US's inflation is driven by growth. It's a lot harder to deal with than inflation driven by demand, because demand eventually subsides when demand and supply meet each other at a place where consumers stop spending as much. And so, given this demand dynamic, US inflation is expected to ease but remain higher than it is in Europe, projected to reach 2.9% for this year. And despite this resilience, there's still threats on the horizon, though. We've mentioned some of them. Commodity prices due to ongoing conflicts in the Middle East, the Ukraine conflict, sluggish productivity, and overall geopolitical fragmentation coming out of the pandemic. There's also some more info in this report that's interesting to me. The caller actually mentioned part of that, which is Chinese growth is expected to decelerate, while India's growth is forecasted to be even higher than it was originally forecasted last year, which really just reflects kind of India's status as one of the fastest growing economies in the world. Still, with all this, my big takeaway is that even though the trend of reshoring and friendshoring and really overall shift in global supply chains seems to be continuing onward, the economic world is still incredibly interdependent. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we like to thank them for their courtesy by getting to their questions quickly. And this question is about AMT or CCI. Please let me know your thoughts on Crown Castle. Now, Crown Castle is a REIT. Let's take a look at this really quickly. And Crown Castle is, sorry, this is loading for all you folks watching. Crown Castle is a tower and fiber REIT. And so tower and fiber REITs actually haven't been doing as well as some other REITs, specifically storage REITs, some gambling REITs. This one specifically is down about 27.31% year over year. And given that communications infrastructure is an important part of the US economy, I actually think that now might be a pretty solid time to get into tower REITs. The cost of tower REITs operating tends to be lower. And so, Crown Castle has a little bit of debt, but nothing that's too over the top. Their financial leverage seems pretty modest, sitting at about six times in 2023. The average over the 5 years is 4.8. So overall, I really don't have a problem with Crown Castle or Tower REITs. I think if you think about the dynamics that tend to drive REIT returns, if you think that the economic forecast is going to be more stable over the next 3 to 5 years than some people project, if you think interest rates tend to be more stable over the next 3 years, then now, given the path of interest rates over the past year and what that's done to REITs, could be a good time to pick up REITs such as Crown Castle. Thanks for the review. Now let's swing back to the InvestTalk voice bank for a question that came in earlier on 888-99-CHART.
Hi, this is Joe in Idaho, and I'm wondering if it is too late to consider shorting DJT. Thank you very much. I'll listen for your answer on the air. And my best wishes for Steve, of course. Bye now.
So DJT, for those of you who don't know, is a meme stock of late, and that is Trump Media. So DJT was the formation of a SPAC merger with Truth Social, and the price ran up from, I believe, 30 before the vote happened to upwards of $70 a share. And now let's see where it's sitting right now. Yeah, it's sitting at $22.84. So it's come down a lot. So here's the danger with these types of names. And it's when they're not fundamentally driven, you don't know what's going to happen to the price. So shorting DJT right now is going to probably be incredibly expensive. The cost of borrowing is going to be expensive because I believe at one point a couple weeks ago, it was the most heavily shorted name within the United States. So, overall with these meme stocks, I don't recommend holding them long. I don't recommend shorting them. It could be dangerous either way, especially now. Thanks for the call. Now we have another live call from Valencia. We're just staying in California. Richard, you were curious about DIV. Do you own it or are you looking to buy it?
Yeah, I do own a small position in this. I know there's been a lot of talk about dividends on the program and so forth, and this particular one, the global Super X dividend fund ETF. What is your assessment of this one?
Yeah, unfortunately, I can't really see it at all. I'm looking at DIV as the ticker, and I'm not seeing it come up. How about this? We will get back to your question tomorrow after we do a little bit more research on being able to get to this ticker, but I just can't find it within my system right now. But thanks for the call.
Okay, thanks.
Unfortunately, that happens sometimes. The tickers don't match up on all these systems in terms of what it's searching for, so sometimes it's a little difficult to find things. But we'll certainly get back to that one tomorrow. Now let's shift gears back over to another story I wanted to focus on today because housing starts came out, and they missed. So in March, U.S. single-family home building experienced a pretty significant decline. And what that really does is highlight some of the ongoing challenges in the housing market because there's also a critical shortage of previously owned homes for sale. And so the Commerce Department reported that single-family housing starts fell 12.4% to a seasonally adjusted annual rate of 1.022 million units. And this downturn comes as a resurgence in mortgage rates, which have climbed back towards 7%. Is deterring potential home buyers and cooling market activity overall. And this decrease in single-family housing starts and really a drop in permits for future construction has actually reached a 5-month low, which suggests that the housing recovery that some saw as rates were coming down is really losing momentum. And the uptick in mortgage rates is really the critical factor that is driving this slowdown because as borrowing costs rise, affordability issues become even more pronounced. And so people that are trying to buy their first home or maybe trade up are having affordability issues, right? This directly impacts new construction activity because if there aren't buyers out there that can afford to buy these homes, builders aren't going to build them. So builders are facing this uncertainty as well regarding the future interest rate movements and economic conditions. And that cautiousness is understandable, but the problem is if you aren't building homes now, that also affects the housing market years from now, right? We still haven't fully recovered from the amount of houses we were building pre-2008. So the backdrop of geopolitical tensions and economic instability is making it even more difficult for builders to forecast how many homes they should be building. And this isn't something that is one size fits all. We talk about this all the time. Housing is regionally dependent. And so there's been noticeable declines in the Northeast and the Midwest and the South, but there's actually been an increase in the West. And so this regional disparity kind of underscores the uneven impact of these economic factors across the country. So what are the long-term implications here? Well, the housing sector struggles have broader economic implications as well. They affect everything from consumer spending to financial stability. And you have to keep in mind that this is the sector that led into the last recession. So some see it as kind of a bellwether into the overall economic climate. And so this month's report on U.S. housing market kind of shows a complex mixture of challenges, not just based on rates, but on economic uncertainty, based on global factors that are really, some would even think are outside the purview of housing generally. So keeping all this in mind, it's very difficult to predict when some of these pressures that have been faced by first-time home buyers will subside. I think we can squeeze in another caller question now.
Hello. Today I had a question about Live Nation Entertainment, tickers LYV. They recently had a little bit of a pullback given the fact that there might be an antitrust lawsuit against the company. So I was looking to see if you think this could maybe present a buying opportunity. It looks like it dropped down to some of the moving averages, or if you think we should be patient. And then what you think the future for this company looks like given other ticket competition companies, or just if there was a recession. I heard about it in a newsletter and I just thought it was interesting. So I just wanted to see what you guys thought. I'll listen on the show. Thanks, guys. Bye.
Yeah, so for those of you who don't know, Live Nation Entertainment is a ticket company. And they recently announced that there was a lawsuit filed by the DOJ based on antitrust violations. And so the DOJ is alleging that Live Nation and companies like Live Nation are artificially inflating costs to consumers. And for somebody that likes concerts as much as I do, I know that over the past 5 to 10 years, the fees associated with buying ticket sales are astronomical. And so this has been something that has been part of the Biden administration's attack on overcharging consumers for quite some time. So just given how serious the administration has been and how the DOJ has been about filing antitrust suits and taking out some of these unfair, what they see as unfair costs on consumers, I just don't see, given the uncertainty, this being a good investment at this time. Thanks for the call. Now we're moving into a quick break, and I hope you call us at 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation. So we found it. We found DIV, the Global X SuperDividend U.S. ETF. And DIV combines a low volatility strategy and a high dividend yield mandate, is what their prospectus says. And so what they essentially are doing are they have some screening criteria on low volatility and high dividend yield, and it has to be consistent over the past 2 years. And so they rank those. And once they select the top 50, they equally weight them. So what does this fund look like then? It is 33% small caps, 33% large caps, and 28% mid caps. It's overweight to finance, energy, consumer cyclicals, utilities, essentially the names that you would expect to pay consistent dividends. So, I kind of like this fund. It's a little expensive at 45 basis points. So that is my kind of one red flag here, but it's giving you pretty good small cap and mid cap exposure, which tends to be the areas of the market where over the long term, you have higher expected returns, as well as some pretty decent sector weightings. So, maybe there are some funds that you can get cheaper, but the way this fund is organizing itself, kind of like. Thank you for calling us live earlier. Now, before we head out for the day, there's one more interesting thing I wanted to note, which is, a lot of people have said for some time that we're in an AI bubble and that market valuations have run away. And although it's true that market valuations tend to be on the high side, I think one interesting thing to note is how the market reacted to what happened in the Middle East over the past week. And really, that reaction can be summed up in one word, which is measured. So why is this important? Well, markets don't tend to react to geopolitical events in a measured way when you're in a market bubble. So on the day of the Iranian attack on Israel, typical safe haven assets like gold and oil initially spiked. And that was over the weekend when markets were closed. And bond yields and stocks dipped. But by Monday, that had largely reversed. And so this rational behavior underscores a level of, let's say, market maturity that despite high valuations in stocks, there wasn't a crazy reaction. So what does this mean for investors? Well, it could mean that investors aren't just blindly speculating like some people thought. It could mean that while valuations are high, they may not necessarily be in a bubble territory as some have feared. And it also suggests that current market conditions are less volatile than in past bubble scenarios. Now, on the flip side, the market does still show signs of frothiness, elevated volatility in niche sectors like AI, and the behavior around meme stocks, those story stocks like DJT, where valuations were kind of devoid from the reality of the fundamentals. And there's also a bullish bias in surveys, which while not extreme compared to historical bubble periods, it's still a bit substantial and warrants some pause and caution from investors. Overall, I think the market's response kind of offers a little bit of a mixed view, but certainly something to consider and suggest that even though there are those pockets of overenthusiasm, it may not be an imminent bubble like some people have feared. So investors should still remain vigilant and consider that both the optimistic sentiment and the sporadic signs of excess in specific market areas, while not being overly concerned that the market is going to pop at any signs of strife. I want to talk a little bit actually before we head out about InvestTalk Market Madness. And one of the lessons that we wanted to send to our listeners, if you were able to catch it, is that it is very difficult to predict day-to-day price movements. If you had asked me at the beginning who was going to win, I wouldn't have picked a biotech name, but it's still won nonetheless. So what we're going to do going forward is we're going to actually track these names. And we're going to check in with you 6 months after the competition ended and 1 year after the competition ended. And we're going to take a look at how the short-term price movements compared to the long-term ones. Now, I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify, and please be sure to review and rate us on iTunes. Remember to tell your friends that the InvestTalk podcast is now available in video form on our YouTube channel. So search InvestTalk, and don't forget, it's 2 T's, not 1. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial. Thank you for listening, And your comments and questions are welcome on our 24-hour listener line at 888-99-CHART.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.